Hi. We're going to take a look at the yield curve. And hopefully you know what the yield curve is already, but we're going to take a look now at why does the yield curve have the slope it does at any one particular time. And really the answer is nobody knows for sure, okay? But we're going to look at the three main theories of why it has it. And this is like a kind of this is not like proving or disproving a theory. Okay, this is the ideas as to why it does. Okay, they're called theories, but it's the ideas why it does. And there may be this, on all probability, it's a combination of them. But we're going to see that the first theory is pretty simple. Okay, the second theory is a derivative of the first theory. It just kind of adds something onto it. The third theory it goes in a different direction and probably has something to do with it as well. Different people will call these theories by different names. Okay, so I'm going to try to give you as many of these names as we can, but they do have different names that they are sometimes given by different folks here. So let's start out by just taking a look at the yield curve, at a yield curve, and trying to understand exactly what it is telling us. So let me bring this up on a screen share here. Okay, so if we look over here at this one on the left, we have a typical upward sloping yield curve. Okay, now this is very much simplified. This isn't meant to say here is actually what it looked like at any particular point in time, but you've got a yield curve is a graph. Okay, it is a graph that represents what we call the term structure of interest rates. Okay, so the term structure of interest rates refers to the relationship between a bond's term to maturity, time till maturity, and its yield to maturity. Okay, so any type of a graph, we've got two variables, right? We've got an X variable and a Y variable. And whenever you have an X variable and a Y variable, the X variable should be the independent variable and the Y variable should be the dependent variable. In other words, it's how does the X variable influence the Y variable is what the graph is showing us. So with the yield curve on our x-axis, we have time to maturity. So here is we're showing bonds that mature in 1 year, in 2 years, 10 years, 20 years, and 30 years. Okay, and you can have some yield curves show different times broken out, and some go down, many of them go down as early as 1 month or 3 months, but this is just one, a simple one that I drew out. Okay, so that's on my x-axis is time to maturity. On the y-axis is yield to maturity. So it's saying how does a bond's time to maturity impact its yield to maturity. So here you got 1%, 2%, 3%, 4%, 5% in terms of yield to maturity. And as we know, the yield to maturity is the semi-annual yield doubled. So what this is showing us here is we're saying here is a treasury bond. And I use that term bond generically, okay, because a 1 year would be a treasury bill, actually, right? Okay, so here we've got a 1 year treasury bond that has a yield to maturity of 1%. So this is a treasury. Now, these are all typically done with what they call the on-the-run treasuries, meaning the most recently issued treasuries. So the most recently issued 1 year treasury bill, okay, we're saying has a yield to maturity of 1%. Again, I'm just making all these numbers up. I mean, they could have been real, but I'm making them up just to make it nice and easy to be able to see it here. So here's a 1 year treasury has a yield to maturity of 1%. And then we have the most recently issued or on the run 2 year treasury note has got a yield to maturity of 2%. Here's a 10-year treasury note that has a yield to maturity of 3%. Here is a 20-year treasury bond that has a yield to maturity of 4% and a 5-year treasury bond. It's got a yield to maturity of 5%. So these are all separate treasuries, but they're all at one point in time. So at one point in time, at 3 o'clock in the afternoon Eastern time on on Friday, September 30th or whatever. Okay, you take a look, and at that moment in time, take a snapshot. What were the yields at that point in time for each of these different treasuries? This is what we're seeing here. So you put a dot where their yields are, and then you just play like you were when you were a kid, connecting the dots. We connect the dots, and that is the yield curve. And so an upward sloping yield curve is saying that longer term bonds have a higher yield than short term bonds. So in other words, long term interest rates are higher than short term interest rates. Okay. And that is normally the case. Probably 80–90% of the time, you will find this to be the case, that longer term bonds have a higher yield than shorter term bonds. And it won't always be a nice straight line like what I've got here. Sometimes it'll be a little bit more flatter at the beginning, and then it goes up more. Maybe it'll be a little bit higher slope at the beginning, and then it's a little bit flatter later on. But so it doesn't take an exact shape at any point, one point in time. But this is just, again, an example of an upward sloping yield curve, meaning longer term bonds, okay, have higher yields than shorter term bonds, or long-term interest rates are higher than short-term interest rates. Okay, upward sloping yield curve. Now over here, what I've shown is what we call an inverted yield curve, or a downward sloping yield curve, mean the same thing. We don't see this that often, but we do see it sometimes. Okay, where long-term interest rates are shorter than short-term interest rates. So I could invest, for example, in a 1-year treasury bill and get a 5% rate of return, 5% for 1 year. If I bought a 2-year treasury note, the yield would be 4%. 10-year treasury note, 3%, 20-year treasury note, 2%, 30-year treasury note, 1%. This is pretty extreme. Okay, I don't think you'll see something that is this extremely downward sloping. But I just wanted to make it nice and easy to be able to see here. So we're saying here it's the same thing, that the time to maturity is what is influencing the yield to maturity. But in this case, okay, the longer time to maturity is leading to a shorter yield to maturity, and a shorter time to maturity is yielding a higher yield to maturity. Okay, so now the question is, why do we sometimes see a upward sloping yield curve, and why do we sometimes see a downward sloping yield curve? And by the way, we could also have a flat yield curve. A flat yield curve would be something where, for example, short-term interest rates are yielding 3%, medium-term interest rates are yielding 3%, and long-term interest rates are yielding 3%. So if they're all yielding 3%, you put your dots there and connect them, it's going to be a flat line. Okay, so that would be a flat yield curve. Well, the first theory of the yield curve, or the first idea as to why this might happen, okay, is called the pure expectations theory. Sometimes that's called the unbiased expectations theory. And the two different terms mean the exact same thing, just depends on who you're talking to or what textbook you're looking at. But this is a simple theory, okay? It says that implied forward rates, this is why it was important that we learned implied forward rates. Implied forward rates are unbiased predictors of the expected future spot rate and represent the market consensus. Okay, so let's break that down. It's saying that in this particular theory of the term structure, that investors, if they are looking to invest money for 30 years, they don't care whether they invested into a 30-year treasury bond or whether they invested into a 1-year treasury bill and roll it over 30 different times for the 30 years. Doesn't matter. They're going to go with whichever one they believe is going to give them the greatest amount of money at the end of the 30 years. So if investors feel that they will get more money by locking in a 30-year treasury bond for 30 years, that's where they will go. If they feel that they will get more money by going into a 1-year treasury bill and rolling it over 30 different times, then that's where they will go. So let's take a look at the whiteboard here, okay, and see what the implications of this are, okay? So here is time 0, here is time 1, time 2, and we go all the way up there. Here is time 30, okay? And I'm simplifying this a little bit, okay, on this, but this is the idea behind it. Okay, so investors have two choices if they want to invest money for 30 years. They can go into a 30-year treasury bond. Guess what? Okay, that's Z60, isn't it, right? So it's 60, excuse me, it's 60 6-month 6-month time periods there. Okay, but that's a Z. Or what they can do is they can invest in a 1-year treasury bill, roll it over to another one, roll it over to another one, roll it over to another one, and keep doing that all the way out here for 30 times. Okay, 30 1-year treasury rates, and they're going to go with whatever is the highest. Well, based upon that, okay, investors must have some expectations of what they think these rates are going to be. These Z's are going to be out in the future. Okay. And so what they think those zeros are going to be out in the future, the short-term zeros are going to be, is what the implied forward rates are today. So the pure expectations theory, or the unbiased expectations theory, says that the implied forward rates are actually what investors believe the spot rates will be at that point in time in the future. Well, this makes the implied forward rates tremendously significant for us, because if we want to look out here, oh, let's just say this happens to be 10F11, okay, 10F11, okay, what that implied forward interest rate tells me what is the consensus view around the world of bond investors. What is the consensus view of what the 6-month interest rate will be 5 years from now? Okay, because starting at time period 10 is 5 years from now. So probably shouldn't have drawn it in the middle of the timeline, but anyway, that's what that is saying there. So if I calculate all of the implied forward rates, that is telling me what investors actually think. Okay, so that's this first theory of the term structure. The first theory of the yield curve is that the implied forward rates are unbiased expectations of what the future rates will be. So what does that mean? Why do we see an upward? Why might we see an upward sloping yield curve? Well, remember, an upward sloping yield curve says that the 30-year bond, okay, is getting a higher yield than the 1-year bond. But if we have this unbiased expectations theory, the 30-year bond must be an average of what investors expect the 1-year bond to be each year for the next 30 years. So in other words, this right there has got to be a geometric average. Okay, we'll call it an arithmetic average for right now, because it makes it a little bit easier to work with. But this is an average right there of what investors expect this, and all of those to be, right? Because that was what we found with implied forward rates, okay? That this was the geometric average of all of these implied forward rates along the way. Well, let's think about what that actually means. If you can get a 5% return right there, and you can get a 1% return, okay, right here on this this 1 year, okay, if 5% is an average of what the 1-year rates will be for the next 30 years, and right now you can only get a 1% rate of return, it must mean that investors are expecting interest rates to go up. Okay. Again, if we go back to our let's go back to our yield curve. If we have this upward sloping yield curve here, okay, where the 30-year bond is getting 5% and the 1-year bond is getting 1%, this, okay, according to the unbiased expectations theory, this 5% yield is an average of what investors expect the 1-year bond to be getting each year for the next 30 years. Well, if the 1-year bond is currently getting 1% and investors expect it to average 5% over the next 30 years, gee whiz, they must be expecting that 1-year bond to go up. Okay, the 1-year rate to go up, because it can't average 5% over the next 30 years and stay at 1%, right? If it stays at 1% each year for the next 30 years, it's going to average 1%. Okay, so it's got to be going well above 5%. So this upward sloping yield curve is an indicator that investors expect short-term interest rates to be going up. They expect the short-term rates to average 5% for the next 30 years. And if they're going to average 5% for the next 30 years and they're only 1% right now, they must be expecting them to go up, because they must expect them to actually be getting well above 5% sometime within the next 30 years. So based upon the pure expectations theory, okay, if we see an upward sloping yield curve, it is because investors are expecting short-term rates to be going up in the future, so that they average that higher long-term rate over that period of time. Now, suppose we see a downward sloping yield curve. If we see a downward sloping yield curve, that's telling us in this example that investors are expecting short-term rates to average 1% over the next 30 years in this example. But guess what? Short-term rates are right now 5%. So if the 1-year rate is right now 5%, but investors are expecting it to average 1% over the next 30 years, that must mean that investors are expecting short-term rates to be going down. So the pure expectations theory, or the unbiased expectations theory, says that long-term rates are the market consensus of what investors expect short-term rates to be averaging over that period of time. So if we see an upward sloping yield curve, it's telling us investors are expecting short-term rates to go up. If we see a downward sloping yield curve, it tells us investors are expecting short-term interest rates to be going down. Or what if we see a flat yield curve? Well, if we see a flat yield curve, that's telling us that investors are expecting short-term rates to stay pretty much where they are. Okay, so if we have a situation where short-term interest rates are at 3% and long-term rates are at 3%, 3% for the long-term rate is an average of what investors are expecting the short-term rates to be over the next 30 years, and they're currently at 3%. You must expect them to be staying pretty much the same. So now economically, okay, with economics, what does this tell us? Well, why, if we see an upward sloping yield curve, why would investors think that short-term rates are going to be going up? Who has an influence over short-term rates? The Federal Reserve. The Federal Reserve has limited impact on long-term rates. They have some, but it's really very limited. They have a huge impact on short-term rates. They can pretty much dictate the very short-term rates. Okay, they can't over the long-term rates, but we're not going to get into what the Fed does and the money supply and all that kind of stuff here. But let's just be it understood that the Federal Reserve has a big impact on short-term rates, small impact on long-term rates. So if we see an upward sloping yield curve like this, okay, investors are saying, hey, we are expecting the Federal Reserve to be raising short-term rates over the next 30 years. Why does the Federal Reserve raise interest rates? They generally do so when they see inflation and an overstimulated economy. If the economy is getting too hot and inflation is getting too high, they will raise interest rates. So an upward sloping yield curve is oftentimes an indicator, and this is now, there's two other theories we haven't even gotten to yet, but it's oftentimes an indicator that investors are expecting inflation to be coming up, and which would mean that the Federal Reserve would be raising short-term rates. How about if we see a downward sloping yield curve? Well, that is an indication that investors expect short-term rates to be coming down from where they are right now. What would cause the Federal Reserve to be lowering short-term rates? If they feel that they need to stimulate economic growth, perhaps because of a recession. If you have ever heard, and you may have, that a downward sloping yield curve is an indicator of a recession, it is not really telling you that there's going to be a recession, but under this theory, it is telling you that investors think there's going to be a recession. And if investors think there's going to be a recession, they then think that the Federal Reserve is going to be lowering short-term interest rates to try to stimulate the economy as a result. If they believe that the yield curve, if they believe that the Fed is going to be lowering short-term interest rates, okay, then you would see a downward sloping yield curve, where this is an average of where they think this is going to be over the next 30 years. So it must be coming down. And I've been using these two extremes, so the 1 year and 30 year. The same thing would be true here. This would be what investors think is the average of the short-term rates going to be for the next 10 years. Okay, this would be the average of what they think it's going to be for the next 2 years. This would be an average of what they think it's going to be for the next. This would be 20 years. This would be 2 years, et cetera. Okay, so theory number one, okay, says that whatever you see for the long-term rates, that is a geometric average of what investors expect the short-term rate to be over that period of time. That's the unbiased expectations theory, or sometimes called the pure expectations theory. And if I go to our class notes on this, you can see it's mentioned right in there, okay? But there's a couple of problems with this theory, okay? The first problem is that, in fact, the implied forward rates don't end up being great predictors of future spot rates, okay? They don't do a great job, okay? And one of the reasons they don't end up doing that is, as we said before, about 80, maybe 90% of the time, we've got an upward sloping yield curve. Well, if investors were on average correct, okay, with this pure expectations theory, that would mean 80 to 90% of the time, investors are expecting interest rates to be going up, short-term rates to be going up, and 80 to 90% of the time, if they were on average right, they would be going up. Well, you can't have rates going up 80 to 90% of the time without them being through the roof, okay? It's not realistic to say that 90% of the time interest rates are going up and 10% of the time interest rates are going down, okay? It should be something closer to 50-50. If interest rates are going down almost all the time, then they're going to be at zero or go negative. If interest rates are going up all the time, then they got to be through the roof, okay? So there's a problem with this, okay? The other problem with this is that it assumes risk neutrality, that investors are indifferent between investing in a long-term bond, like a 30-year bond, versus a 1-year treasury bill and rolling it over each time. Well, we know already, due to interest rate risk, that longer-term bonds have more interest rate risk than shorter-term bonds. If interest rates go up, the price of a bond goes down, but it goes down by much more for a longer-term bond than a short-term bond, okay? So based upon interest rate risk, long-term bonds have more risk in them than short-term bonds. So this concept is what leads us to theory number two. Theory number two starts with the pure expectations theory. It says, okay, let's start with this idea that implied forward rates are predictors of expected future spot rates, but they're not unbiased predictors, okay? There is also built in something that we call a liquidity premium. And by the way, theory number two, some people call it the biased expectations theory, some people call it the liquidity premium theory, okay? Means the same thing. It means that long-term rates are an average of the expected future short-term rates plus a little liquidity premium to compensate for the fact that they are riskier. So theory number one would say this right here, okay? That long-term rates, okay, I'm using Z2 as a long-term rate there, is long-term rates are going to be a geometric average of the expected short-term rates, okay? Theory number two takes it one step further and says, no, we also have to add this liquidity premium here, that the long-term rate is going to be more than an average of the future short-term rates. Well, this helps us out by seeing with the idea that most of the time we see an upward sloping yield curve, because that long-term rate is, under this theory, is an average of what we expect the short-term rates to be, plus a little bit more, okay? And that little bit more that is there is what we call the liquidity premium. Now, how much is the liquidity premium? It's going to vary at different times depending upon people's attitudes towards risk. And there are economists who try to do some sort of an estimate of what the liquidity premium is, okay? If you're going to go with this theory number two. But the exact numbers are not important for us, okay, here. But let's take a look back at our diagram that we were looking at a minute ago, okay? And what we're going to see here is that under theory number two, this is not an average of what we expect this to be over that period of time. It's a little bit higher than an average. So maybe the average would be, oh, maybe let's say right here, about 4% or 3%. And as a result, the liquidity premium is what brings it up the rest of the way, okay? So a steeply upward sloping yield curve is still an indicator that investors expect short-term rates to be going up, okay? But that you would have a moderately upward sloping yield curve if investors expected short-term rates to be level. So let me draw this out for you here on the whiteboard, okay? That here's our yield curve, that if investors are expecting interest rates to stay level, under theory number one, you would see this, okay? But under theory number two, you would see something like this, okay? And the difference, okay, going up from here up to there is the liquidity premium, because these long-term bonds are riskier than the short-term bonds. So even though investors expect short-term rates to be staying level, they still require excuse me, a little bit higher yield for the long-term bonds as compensation for that risk, which is what we call the liquidity premium in there. So if you do observe a flat yield curve under theory number two, it must be that investors expect interest rates to be going down, short-term rates to be going down, and this liquidity premium is kind of pulling them up to be level out here. And that under theory number two, if you see a downward sloping yield curve, that means that you're really expecting interest rates to be going down, because this number right here is still being boosted up by the liquidity premium, okay? Yet it still is lower than the short-term rates. So this kind of jives a little bit more with what we see, okay? If we see that most of the time we've got upward sloping yield curve, it's because even if expectations are that long-term, even if the expectations are that short-term rates will stay where they are, you're going to see an upward sloping yield curve. If the expectation is that short-term rates will be going up, you're going to see a steep upward sloping yield curve. If you see a flat yield curve, okay, it must be that investors are, which you don't see that often, investors are expecting short-term rates to be going down. And if you have a downward sloping yield curve, they must be expecting them to go down quite a bit. Okay, so that's theory number two, which is a derivative of theory number one. Theory number one says that is the pure expectations theory. Theory number two is the biased expectations theory. Theory number three is different from those two. It doesn't have anything to do with excuse me, implied forward interest rates and investors' expectations. Theory number three, which I will show you here in a second, okay. Theory number three is based upon supply and demand. And theory number three says that we basically have, and you can break it down differently from this, but we have three different segments of the market. And that's why it's called the market segmentation theory. Some people call it the preferred habitat theory. Some people separate the two and say you have a market segmentation theory separate from a preferred habitat theory, but they're very similar to each other. So we're just going to kind of combine them together, and we'll call it the market segmentation theory. But it says we got three different segments of the market. We've got short term, okay, medium term, and long term. And what we're saying, what is being said here is that investors want to invest either short term or medium term or long term. That they're not willing to invest long term by investing in short term and rolling it over continuously. Okay, if they want to go long term, they're gonna invest long term. If they want short term, they're gonna invest short term. And it also says that people are looking to borrow short term, medium term, and long term. So we've got those who want to lend short term, medium term, or long term, and those who want to borrow short term, medium term, or long term. Now, let's go back to one of your first economics classes where you learned about the laws of supply and demand. Okay. And you learned with supply and demand, you have price on your vertical axis, and you have quantity on the horizontal axis. And the demand curve is downward sloping, okay? That when you have a lower price, you have a higher quantity demanded, right? And when you have a higher price, you have a lower quantity demanded. You also learned that the supply curve was upward sloping, that when you have higher price, people want to produce more of something. And when you have a lower price, people want to supply a lower quantity. And you learn that the intersection of the supply and demand curve would be the equilibrium quantity that is out there and the equilibrium price. Okay, well, how does this apply to money? Well, money, think about as being a commodity. Okay, just like butter or pizza or anything else. Okay, or your computer chips, whatever you want to have on here. Okay, what is the price of money? The price of money is interest rates. So on our vertical axis where we've got price, when the commodity is money, this is going to be interest rates. Okay, so this is specifically going to be short-term money. This is the quantity of short-term money, and this is going to be interest rates on short-term money. Now what we're saying, okay, the demand curve is people wanting to borrow short-term. So this is saying when interest rates are low, people want to borrow a lot of money. That makes sense. And when interest rates are high, people want to borrow less money. Under the supply curve, this is saying, this is talking about people wanting to lend money. Okay, the supply of money is people wanting to lend it. That if interest rates are low, people don't want to lend much money, but if interest rates are high, they want to lend more money. Okay, so this is the demand to borrow money. This is supply of money being lent. And the equilibrium is going to be the intersection of it. Okay, and this is specifically short-term money. So this is going to be the quantity of money that is borrowed and lent. And by the way, the amount of money borrowed has to be equal to the amount of money that is loaned, because you can't borrow money unless somebody's willing to loan it. You can't loan money unless somebody's willing to borrow it. So this is the equilibrium quantity right here. And more importantly, this is going to be, this I star is going to be the equilibrium price or the equilibrium interest rate. So this is going to be our short-term interest rate. And it is determined by the demand curve and by the supply curve. This is the demand curve is people wanting to borrow money, and the supply curve is people wanting to lend money or willing to lend money. So how much do we have to lend, okay? And how much do people want to borrow short term? We do the same thing with medium term money. This is people who want to borrow maybe, 5 years to 15 years or something like this. And people, the demand curve is people, the supply curve is people who want to lend 5 to 15 years, and the demand curve is people who want to borrow 5 to 15 years. And so again, your equilibrium here is going to be the medium-term interest rate. And you could break it down even more. I'm just making it simple here, just doing short, medium-term, long. And then long-term is people who want to invest, okay, the supply of money for 30 years, okay, the demand curve with people who want to borrow 30 years, for example, for a mortgage, okay. If you want to get a mortgage, most people aren't interested in getting a 1-year mortgage and rolling it over for 30 years, okay. So that would be consistent with this theory, that people who want to borrow long-term have a demand for long-term money. And so that's going to give us our long-term equilibrium rate. So now if I've got a short-term equilibrium rate, medium-term equilibrium rate, and a long-term equilibrium rate, when we see an upward sloping yield curve like this, what we're seeing is here's short-term in terms of time to maturity. There's my short-term equilibrium rate. Here's medium-term in terms of time to maturity. There's my medium-term equilibrium interest rate. And here's long-term in terms of time to maturity. And here's my long-term equilibrium interest rate. So an upward sloping yield curve in this particular situation says that there is when you've got an upward sloping yield curve, means there's a greater supply of short-term money and a greater demand for long-term money. Okay, and the reverse would be true if you've got a downward sloping yield curve. Okay, so these three theories do not necessarily directly contradict each other. There can be parts of each of them that are in fact true, but these are the three. Rather than calling them the three theories, I think it's better to be able to say these are the three forces that will impact the shape of the yield curve. So if you're looking at the yield curve and you observe a certain yield curve, so let's say, for example, we're sitting here today, okay, and this is the yield curve we see today. And we want to say, well, what does this mean? Why is it that long-term rates are here and short-term rates are there and medium-term rates are there? What is this telling us about the economy? What is this telling about investors? What is it telling about us about what investors think is going to be happening in the economy? Well, it depends. It depends upon whether you want to look at the unbiased expectations theory, or whether you want to look at the biased expectations theory, or whether you want to look at the market segmentation theory. Okay. And if you want to, let's suppose you're the Federal Reserve and you want to impact the yield curve, okay, how are you going to do that? Okay, well, we said that they've got limited resources that they can deal with long-term, but one of them is they can buy long-term bonds. If they buy long-term bonds, then that is going to, based upon the market segmentation theory, that's going to increase the demand for long-term assets, and it's going to decrease the supply of long-term assets, which is going to have an impact. And based upon theory number one, if they want to impact things, then they can send out signals that they are going to be raising interest rates over the coming years, or signals that they're going to be lowering interest rates. So all of these things have got to be considered not only by the Federal Reserve, but by all investors. Okay, as you say, hey, why does the yield curve have the shape it particularly does? So this, by the way, we have spent certainly a relatively short period of time on this. There have been literally hundreds of research papers written on this, and each of these research papers are probably 20 to 30 pages. There have been books written on this topic, okay, but we're just covering it in a relatively short period of time. So we're just getting the 30,000 foot overview on this, but that's okay. If you want to learn more about it, read more about it in your textbook, because it does go into greater detail. But I wanted you to be exposed to, and not just exposed, but I want you to understand those three theories, okay, and how they are different from each other, and what each one of them is saying about investors, and what investors think is going to be happening in the future, particularly for numbers 1 and 2, and what's going on with supply and demand for number 3.